Struggling to make consistent profits in trading? You're not alone. Most traders lose money because they dive in without a clear, proven plan. In this video, I'm going to show you a powerful smart money day trading strategy that walks you step by step from analysis to entry, using mechanical rules you can actually follow. No fluff, no guesswork, just a structured approach that gives you a real edge. If your entries are off or you're tired of random losses, this strategy could be a game changer. Watch till the end, you don't want to miss this. This day trading plan is designed for traders who open and close positions within the same day, avoiding overnight risks while targeting short-term price moves. It strikes a balance between the high-frequency stress of scalping and the slower pace of swing trading, offering steady opportunities without extreme volatility or overnight exposure. What makes it even more powerful is how well it integrates with smart money concepts like liquidity grabs, order blocks, fair value gaps, and market structure. To trade this strategy effectively, you need to grasp the latest evolution of these smart money principles. They're the foundation of the system and the key to spotting precise, high-probability entries. Let's start with supply and demand. Key zones on the chart where price moved away rapidly due to strong buying or selling pressure. These areas mark where institutions or large traders likely entered the market, and when price returns to them, we often expect a reaction. But not every zone is worth trading. To identify high-probability supply and demand areas, you need to consider three key factors: inefficiency, break of structure, and the distance of the push away from the zone. Each one reveals how committed the market was to that move and helps you gauge whether the zone is strong enough to hold when price comes back. To spot strong supply and demand zones, you need to look deeper than just price reactions. First, watch for inefficiency. When price exits an area aggressively, it often leaves behind fair value gaps between candles, signaling an imbalance where orders were left unfilled. These gaps act as magnets and potential turning points. Next, look for a break of structure, BOS, where price pushes through a key support or resistance level, confirming a shift in market sentiment and strengthening the zone's credibility. Finally, consider the push distance. The further price travels away from a zone before returning, the more likely it is that the rejection was driven by real institutional intent. Combining these clues gives you a sharper edge in identifying zones with true trading potential. Take this example from the Tesla hourly chart. By drawing zigzag lines, we can clearly see the highs and lows, and one recent impulsive move stands out. It checks all the boxes for a high-quality demand zone. It left behind a fair value gap, broke through previous structure, and pushed price significantly higher than earlier swings. When price returns to this zone, there's a strong likelihood it will reject and continue upward. But if price breaks and closes below this zone, it's a major red flag. Buyers have lost control, sellers are stepping in, and the uptrend may be over. This kind of breakdown is what we call a change of character, a powerful signal that market sentiment has flipped and momentum now favors the downside. A change of character can be a strong signal, but it's not always valid. In certain market conditions, what looks like a reversal might actually be a trap. Let's break this down. Imagine price breaks below a major swing low that initially sparked a bullish breakout. At first glance, this looks like a clear shift in market sentiment. But if you check the left side of the chart, you might notice that this level sits right in a liquidity hotspot, where many traders likely went long and placed stop losses just below. Smart money knows this, and they'll often drive price down to trigger those stops, sweeping liquidity before reversing in the same bullish direction. The key takeaway: when a major level aligns with a pool of liquidity, that breakdown is often just a liquidity grab, not a real change of character. If price reclaims the range afterward, it creates a prime opportunity to go long, as the trend is still bullish and the sell-side liquidity has already been cleared. But that's just one scenario. Another common reason for false change of character signals is fair value gap mitigation. These gaps act like magnets. Price often retraces to fill them before continuing the trend. That's why spotting FVGs should be one of your first steps when analyzing the chart, especially on intraday timeframes like the 4-hour, 1-hour, or lower. Recognizing these patterns can help you avoid fakeouts and enter with the real momentum. So here it is, guys. By understanding the nuances of liquidity, fair value gaps, and changes in market structure, you'll be able to identify high-probability trades that most traders miss. Remember, the key to successful trading is not just spotting opportunities, it's knowing when to stay out of the market and wait for the right conditions. If you're ready to take your trading to the next level and apply these smart money concepts, make sure to hit that subscribe button and turn on notifications so you never miss a strategy update. Drop a comment below if you've encountered liquidity traps or if you want me to dive deeper into any of the concepts we covered today. Let's continue mastering the market together. Thanks for watching.